Good afternoon, everyone, and thanks so much for joining us for today's webinar. My name is Marianne Hensley. I'm the Vice President of Media Operations here at FreightWaves, and we are happy to present today's webinar in partnership with Uber Freight. Today, we're going to be exploring trends and innovations in the transportation industry around procurement, including how the industry can evolve when it comes to using data to inform our procurement decisions. We'll be hearing insights from Bill Driegert, Head of Operations for Uber Freight, and Chris Kaplis, Senior Research Scientist at MIT and Executive Director for the MIT Center for Transportation and Logistics. We'll also have a live Q&A with both speakers following the presentation. Before we get started, I'd like to cover just a couple of quick housekeeping items. First, if you have any issues during the webinar, feel free to reach out to our team via the chat function in your Zoom control panel. Also, if you have any questions that you would like to ask our speakers, please enter those through the Q&A button in your control panel, and we'll answer as many of those as we have time for during the live audience Q&A following the speaker presentation. At this moment, I'd like to go ahead and introduce Bill and Chris. Welcome, guys. If you would just take a moment to tell us a bit about yourselves. Bill?
Yeah, absolutely. This is Bill Driegert. Excited to be on this webinar today with Chris. I've actually known Chris since 2004 when he first joined MIT. So I graduated the MIT Supply Chain Management Master's Program in 2003, so right before Chris came on board. And that's actually when I first got introduced to freight as well, because one of my classmates at that time was Jeff Silver, who of course went on to found Coyote Logistics, and he sold me on the idea. And so I joined him at Coyote in 2006 and have been in freight since then. And now with Uber, back in 2016, Uber made the decision that they wanted to get into freight as well. And so I came on board to help build Uber Freight, and I've been doing that for the last 2 years, and it's been quite a interesting ride to see how freight has evolved and technology has evolved in this space. So thanks for having me.
Absolutely. And how about you, Chris?
Yes, thanks. I'm glad to be here, and I've taken a slightly different path than Bill. We kind of came to the same place, but very different paths. I was a civil engineer in undergrad, and I went in the Army and built things and blew things up. But then when I got my master's degree, when I got out, I got into transportation, but it was more of the building roads thing, which I kind of liked. And then I got my PhD here at MIT, and I focused more on using roads, so more freight transportation logistics. And so that's how I got interested in this area. And my dissertation actually dealt with transportation procurement. It was dealing with combinatorial auctions within transportation procurement. And following my PhD, I put it into practice, and I joined a company called Sabre. Actually, it was PTCG, became Sabre, became logistics.com, where we introduced combinatorial auctions and transportation procurement from 1996 on, and it's now become pretty much an industry standard. But that's what I did throughout the late 90s and early 2000s. Then I came to MIT in 04, actually halfway through 03. Once Bill finished, I was safe to come, and I took over the graduate program. But since then, I run something called Freight Lab here, where we look at freight transportation and a lot of research projects there. I also help run the center here, which is a large center with about 100 researchers and staff looking at how to improve all aspects of supply chain management. In addition to that, I'm the chief scientist at Chainalytics as well, dealing mainly in their freight market intelligence consortium area. So that's me.
Awesome. Thank you guys both. I'd love to just kind of start by talking a little bit about how procurement has really evolved in the transportation industry kind of over the years. We know that it's largely relationship-based. What is kind of the significance of that, and how are we looking to evolve moving forward, Bill?
Yeah, sure. I'll touch on that. Yeah, and actually, when it's a very, I'd say, poignant question for me here at Uber Freight, because we heard this quite a bit early on, because of course, we think of ourselves as a tech company, and certainly we're trying to bring better technology to the market. But one of the points we heard early on was, well, it's a relationship-based industry. So how do you convert a relationship-based industry to more of a tech-enabled industry? And I think to start, it's important to understand what a relationship means. What do people mean when they say relationship-based? And really what they're saying is trust. It's about building trust with the provider, building trust with the shipper. And the reason that trust is so important in this industry is because freight's very volatile. It's also very opaque. There's a lot of information asymmetry. People are making both sides of a transaction with incomplete information. And both day to day, but also when you get into contract negotiations and RFP negotiations, you don't have perfect information. So you want to have trust that from a shipper perspective, you want to trust that your carrier is going to be there when the market's tight, when the rate is still going to, as a carrier, you want to trust that a shipper is going to give you consistent freight, up or down, that if the rates drop and the out of the market, that a shipper is not going to go back to market and renegotiate. In practice, that sort of long-term relationship and commitment doesn't happen that often, which is why there is a lack of trust.
Will you stand guard? It looks like there's another meeting scheduled.
Oh, I'm sorry. Somebody just, I think we heard somebody else. Yeah. So yeah, the relationships, it's really about building trust. And I think where that changes with technology long term is that technology can at least drive a lot more visibility and transparency into the market. So by having more visibility, capacity around rates, where rates might go, you can thereby make better decisions. That creates more trust. When a carrier knows that a rate is a rate is a rate, and it's not going to move, right? That creates trust. When a shipper knows that a truck's going to show up, and they can see that it's going to show up, that creates trust. So we believe, like, over time, better technology creates trust faster, but relationships still matter because to a long-term, and you're trying to decide on the provider there with you over the next coming years. That's when the relationships still matter, but we believe those relationships can be accelerated, and that trust can be created faster through better transparency, which is enabled through technology.
So I have a slightly different take on that, and Bill and I, it's good that we could disagree a little bit. It'll be for a more interesting conversation. I think we as an industry are suffering from a model that really worked really well for a number of years, and that's the annual bid with an auction, where you spend a month or two getting the data. You give the carriers a couple of weeks to reply back to it. You do a bunch of scenarios, and you assign carriers to lanes. And then that gets fed into a routing guide where the winning carrier on each lane is the primary, and the losers become the alternates. Whether they're notified or not is another issue. But then in tendering, during the second stage, a load comes in, it gets matched to the routing guide, and if it goes, that's awesome. But if it fails, it goes through all the alternates, and then it goes down to the worst case, if the routing guide fails, to a spot auction or to something that's a little more volatile. So that's the way that most shippers have been operating for, 20 years, 20 plus years. And they did that because it made sense at the time. Back in the early 90s, people didn't know what the rates were because we were still getting over deregulation. But that's changed now. And I think what happened is that, we faced the market in 2018 and we saw all the creaks in this process. And so but to change something that has been so established takes a lot of effort, right? It takes something big to make people change from the status quo or the dominant design of procurement. And to quote famous philosopher Mike Tyson, everybody has a plan until they get punched in the mouth. In 2018, shippers got punched in the mouth because the rates went way up, capacity got really tight, and it took a long time. And so now people are questioning whether you do this traditional method with the annual bid and all that kind of stuff. But I don't think we want to throw the baby out with the bathwater. And I'm not arguing to not have data. I think we constantly want to incorporate more data, but I think we want to segment. We want to segment, and the data is helping us determine where do we want to have those deep partnership relationships, where do we want to use more transactional? Because I agree with Bill that trust is important, but I think the level of trust depends on where you're using them in the network. Every relationship doesn't have to be a deep trust. That's my thought anyway. Bill, do you disagree with that?
No, I think that's fair. Because there is, well, I think you're sourcing a truck as an example the same day. You may not have a relationship with that goes up. Just as I don't have a relationship with my Uber driver, right? But I trust again, the data, because I can see the rating of the driver, I can see when they're arriving, I have that visibility, then I have trust that they're going to show up. Because the relationship is about trust that you have that reliability and that consistency and that predictability. But the technology can enable that trust through visibility faster.
Yeah, I agree. And in that relationship, yeah, I don't have trust with an individual Uber driver, but I trust Uber. And so my trust is into the platform. And so I agree with that you've built a level of trust. And I agree with that. The technology can give you, through repetition and the ratings and things like that, that can certainly help. I agree.
Yeah, kind of to Chris's point, you've got a bid process in place that has worked for decades at this point. And yet the industry understands the importance of data, or they say they do. And it seems like data and technology have been applied, successfully to other parts of the business. But procurement is still sort of slower to move in that data-driven direction. Bill, why do you think that is?
Yeah, I think there's a lot of structural messiness within procurement. I think Chris is, as he touched on in his intro, he's kind of been at the forefront of this in terms of like defining more rigorous methods around just RFP management. But I think what's happened is that beyond that, like there's a dominant design which has really it's kind of taken away the risk, it's abstracted the problem a little bit, and it's kind of settled in, hardened around a particular procurement method. I think if you look at how technology is changing supply chain, particularly freight, over the last 10 years, I think there's been a heavy focus on tracking. So to your point, like data is definitely, there is more data available. Companies like P44, FourKites, MacroPoint have really focused on getting better visibility in the tracking space. But I think that the procurement space, if you move upstream, it's been fairly static. I think what's now starting to happen, and us and others are really driving, is that now you have kind of real-time pricing APIs. You're starting to have kind of real-time visibility. We provide real-time visibility on a 14-day horizon in terms of where rates are. With that, then there's the structural, I'd say, friction around how people procure and how they think about managing transportation. So we've seen very sophisticated shippers that are at the forefront of this start to really rethink all their internal SOPs and how they actually think about procurement. But that takes time. Is where, just to contrast it to tracking, if I can immediately see the benefit of knowing where a truck is all the time. That's very tangible and immediate, and it's very execution oriented, and I can understand what to do with that data. But I don't always know immediately what to do with a real-time price. And we saw this almost immediately. Way back in 2017, I remember having conversations with enterprise shippers where I would say, we can give you real-time prices, we can set up an API, we can integrate into your systems. And they would say, well, I don't know what to do with that data. I can't use it today because I can't even put a new price into my system in less than an hour, right? The system is not built or architected to be able to manage pricing and capacity data on a short cycle. It's architected around kind of longer bid procurement processes. So I think there's an appetite, and there's definitely interest, and there are shippers that are kind of at the tip of the spear, kind of pushing the boundary here. But it's more of a structural and change. So it's going to take more time to really leverage the data that's now coming to market for procurement. That's mine.
I agree with you, Bill, because you're right. The processes and the systems are all built on that. I do a bid once a year, everything goes through. And we've done some more analysis here. And the problem is the classic standard approach is I spend 2 to 3 months forming up what my demand is going to be next year, my forecast. And usually you take last year, you modify it a little bit, but that can take several months. You give it to a carrier, and then they get to put bids on it. Then you're going to analyze it for another 2 to 3 months. So this whole process can take anywhere 6 months. On average, it's about 3.5 months total. But the thing is, you're putting rates in now that are 4 months old, and they're supposed to stick for the next year on a forecast that you made, 6 months ago. So what we're finding is that the half-life of contract rates with shippers is about 4 months. And by half-life, I mean, how many months will it be before when 100% of the rates that are contracted, only 50% of the volume is actually going through those rates that were established after a bid event. So they're only lasting 4 months, so it's falling apart. I think shippers like the stability or the apparent stability of rates for planning purposes, but in the dirty little secret is they don't stick. The majority, not the majority, but 60, 70% will not last that long. So I agree with Bill. The idea that you're going to set rates once a year and they will live for a year, it doesn't happen that often. You see a lot of erosion of these rates. And so I think it argues for something that Bill is saying, that you need shorter timeframes because you need to be more flexible to respond to the market, to respond to changes in your network, and to respond to changes in your own forecast. Because I've yet to see the shipper in the transportation department accurately forecast what their loads are going to be for the next 12 months. It's an impossible task. So I agree with Bill. A shorter time frame makes a lot of sense here.
Yeah, absolutely. And one of our listeners chimes in and just says, you mentioned the changes in the management of RFPs. However, it must be noted that for many years, from well before deregulation era, procurement personnel were not as well trained or as informed as they are today, and their focus was on the lowest price for whatever it was they were purchasing, whether it was products, freight, et cetera. So with the increased training and professionalism within procurement, and freight, and the requirement for customer provider relationships has become more important. Would you guys agree with that?
Sure. I would actually argue that anyone who was actually procuring in a senior position before deregulation is probably retired or very close to it, because that happened in 1980. But I think there has been a change, and I think that's more of a reflection on who owns the transportation procurement process. Is it falling under the CFO for finance, or is it falling under the COO, Chief Operations? Because they're very different focuses. If it's under the finance area, then you see a low cost drive. If it's under operations, then you see a little more shifting to quality and level of service. Bill, do you agree, or do you have a different opinion?
Yeah, no, I agree. I would say there's a huge variance in terms of the sophistication of procurement and transportation procurement, even across the Fortune 500 and large global enterprises. And to the point of the who asked the question, though, I do think that I see more sophistication in certain shippers than I did, say, 10 years ago. That I do think
I agree.
There's better information out there. You're seeing just, I think the market is becoming educated as a result. And I also have seen kind of up-leveling of departments in some organizations, just in terms of who's managing the decision and how they're processing that information. So I think it's a fair point, but I also think that's also why the market is ripe for better tools, because you have more sophisticated departments making decisions that want more information, want more data.
Yeah, that's a great point, Bill. I did a roundtable up here at MIT in February of 2018, and I asked all the shippers that were there, how many of you had a PhD or a technical master's degree person in your department 5 years ago? And maybe 2 hands went up. But then when I asked now, they all went up, because the data is here. Actually, transportation is very sophisticated now. The amount of data that's out there is tremendous, and we're finally tapping it. But one of the problems is, because Bill, you made the point earlier about procurement data and tracking that real time is kind of leading. I agree with that. And in fact, companies, I think, are their worst enemy, in that they tend not to track their history. Very few shippers that I've talked to actually keep what the output of their auction is, or have any sense of how the carriers have responded. And so it's like they start to fresh each year. It's almost like Groundhog Day. And so I think having better data starts with keeping it yourself and knowing what worked and what didn't work for that. But I agree that there's an opportunity now, because we have a level of sophistication within the transportation department and within carriers. Some carriers have gotten very sophisticated here. And so I think that's raising the game across the board with what we can do.
Yeah, absolutely. And kind of talking about, this 3-month-long process or so, this cycle that we go through, and kind of looking out for the next year, and the importance of time and trust in getting to a place where we can trust the data, trust our partners, to be able to make those decisions more effectively based on the right data, based on the information that we have available. what are some of the other steps that you feel like can be taken to kind of move away from that legacy mindset? You know, we've done it this way for decades. Why do we change? I mean, you see it on paper. We know the importance of data, but what are some kind of practical action steps that people can take to start moving in the right direction? Chris, thoughts on that?
Yeah, so I think one thing is, to be able to act on data, you have to have data, right? And so I think, collecting your own data is a good first step. For example, if you're a shipper, do you have your dwell time at your facilities in the same format or within the same file of all of your transaction data? Can you actually map that together? So before you become data centric, which I think is very important, you need to have the data. So that's the first step. I think companies, like I said, they got punched in the mouth in 2018. So this crisis kind of raised above just transportation level, and you started hearing CEOs talk about it in quarterly and annual earnings calls. And when that happened, then the crisis turned into a good thing. And so the job of most transportation managers now is to not let this opportunity of a good crisis go to waste. So what I'm seeing now is more shippers are taking this as an opportunity to experiment and to try different things. And so once you have this data, you can try different approaches because you're getting some leeway and some resources, hopefully, from senior management. To me, that's the first step, is getting the data and then getting the okay to experiment and the willingness to try different things.
Absolutely.
Yeah. So as I would add to that, I would say first is, learning what's out there. So learn what data is out there, what you can get, and then integrate it into the overall kind of vision of the procurement department and how you're thinking about bidding. I would also say that where I think, practically, to give a framework for how I would expect kind of bidding decisions to evolve over time, is to kind of isolate what decisions need to be made at which time. I think one of the misunderstandings of an RFP is that I think a lot of companies view it as like a risk management tool, when it's really not a risk management tool, right? In the sense that, Chris touched on this earlier, but if you get a rate back, that rate may not be valid in 3 months.
Right.
There's huge churn. So I think understanding which decisions you need to make on which planning horizons is key. And then, do you have the right data to make those decisions? So as you're coming into the annual RFP, do you have a solid understanding, or at least do you have your own opinion, an internal alignment on where you think the market's going to go next year? And then how does that change your planning scenarios? So starting with that, and then on a shorter cycle, on an execution cycle, do you understand how you can reprice lanes when you do have spot opportunities? Are you using the best data and the best tools? And when you're making a planning decision for a new facility or a new plant or a new lane, or you're reconfiguring your distribution, do you have the right data available? Are you making the right decisions based on that data, or is your data stale because it's based on an RFP you generated 6 months ago? Do you have real-time data? Have you integrated that into the decision process? So I would say, at first, just knowing what's out there, what data is available, and then making sure you've got the right data for the right type of decision at the right time.
Right. No, that makes a ton of sense, Bill. And so I'd like to think that, having data and having a partnership are not mutually exclusive. In fact, having better data makes better partners. Because one of the fallacies of the annual bid is that it's a one size fits all. And it used to be, you put everything out to bid, you get these wonderful contract rates that always apply. We all know they don't. And so what better data is allowing you to do is to segment your network and segment your carriers and map the different relationship to different parts of your network. So the steady state, high volume lanes, you might want to use a dedicated or a certain set of core carriers. For things that are more sporadic, then you might want to use a different solution. So by having the data internal to your own company, you don't even need anyone else's data. You can analyze your network and try to map that better, the different types of contracts to different carriers. Even once you do a bid, you can get a good handle on how risky your budget might be by looking at the rate of the backup rates in each lane. You look at that routing guide slope, if you will, and you can get a sense of how at risk would this lane be. You can actually try to apply what's the probability of us going to spot, of my acceptance ratio historically for these carriers, so you can get a sense of your budget risk. And so these are things you can do internally with your own data, assuming you have your data, and that you can start understanding and using data to make better assignments of different carriers and different contract forms across your network. To me, that's a good use of data, and it doesn't require anything more than what you should already have. Bill, do you have anything to add to that?
Yeah, no, I agree. I think kind of building on that point, looking at next year as an example, I think there's a lot of variance in how people think the market might play out. I think we believe it'll be in the 2 to 3% rate increase. If you look at the Coyote curve, I think they've got it at 20% plus. But that's a huge amount of variance in terms of what could happen in the market. And so to Chris's point, if you have lanes that you can just lock in where you know it's consistent, you get an asset provider, you can make a commitment to the carrier and they can make a commitment to you, then now's a good time to lock those rates in. If you have other lanes that are going to be a lot less consistent, or you can't predict what the volume is going to be. If it ends up coming in at 20%, 30% plus, then just expect that you're going to have a lot of like fallout from the routing guide, right? You might have reliability issues and challenges. So I think understanding that, modeling it out, and making sure you're using the right lever and the right type of contract for the right type of freight.
Right. I love it, Bill, that we're calling it the Coyote curve. It's the Coyote curve now, or it's the Pickett.
I'll give Pickett credit where it's credit.
I'm going for the Pickett curve. Yeah,
the Pickett curve.
Yeah, but another thing for data that you can do, and I think you guys at Uber Freight are doing a really good job with this, is data about each shipper's own facility. Like I said, a lot of shippers have no clue in the transportation department about how the operations at the different facilities work, what the dwell time is, how much time does it take for loading. And we found that has a huge influence, not only on the rates that you will get, but also on the availability of capacity. So by collecting data of the actual dwell time or the gate-to-gate time that carriers are feeling, then that can help you get a better idea of, one, identify where the problem is. Two, you can try to map and see exactly how much that is costing you in terms of increased rates. But third, you could use this to justify changes that might be out of the transportation manager's control. It might be a warehousing issue or a property issue. Then you can use that to try to enact change. So I think you can use data for a lot more things than just the procurement side. You can use it now to change your operations that in turn will lead to possibly lower rates. Because I know Uber Freight's been doing this for a while with their driver feedback.
Actually, to build on that, we implemented facility ratings last year. We have well over 600,000, I think on our way to 700,000 ratings in the system, over 70,000 plus facilities, and that's a lot of the conversation. Is you can impact rates by operating your facilities more efficiently and limiting dwell time. And that data, we are now making that data public, and so shippers can see it. But that data already had made its way into rates and into the ecosystem, in the sense that a lot of that information was already tribal knowledge. If you ask a carrier about a specific facility, they often already know if that's a good or a bad facility just based on reputation. And those reputations, they percolate throughout the ecosystem. At truck stops, drivers talk to each other. Carriers, they have that information already, and they're already baking that into the price. If they think they're going to get held up for 5 or 6 hours, then they'll put that into the price up front. But oftentimes the shipper may not have visibility. Maybe it's not their facility, maybe it's a vendor or supplier.
Right.
But once they have that intel, they can operate on it. And we're seeing that more and more is action driven by that intel that previously they didn't want.
Yeah, because that's a critical thing, because if you look at the amount of time a driver can drive during the day, it's about 11 hours, right? But if you look at data, the actual average amount of time or hours that a driver over the road, truckload, for-hire carrier drives is about 6.5. So you have a lot of room there, 4.5 hours of whatever. It's waiting time, it's non-productive time. And so if we can improve some of that, that can not only help you lead to lower rates, but it can also kind of lessen the driver shortage issue. So there's an open question whether there is really a driver shortage issue, or is it just a poor utilization issue? And this all goes to how well the operations happen at the nodes. Too often, transportation, we focus on the links or the arcs, right? The cost on this lane or that lane. But we're finding one of the big bottlenecks are the operations at the nodes in the network, the facilities.
Yep.
And so that is another area of focus that I know, Bill, you guys are doing a lot of work on.
Yeah, and that's where shippers can directly action and improve their own transportation costs by just making their own networks more efficient. We surveyed our owner operators, and we know from the owner operator population, 30–40% of the time is just waiting, right? Their time is spent just waiting because it's all live, like they're not doing drop and hook, right? They've got to wait for at both ends no matter what. And that's a huge amount of inefficiency. When you consider there's 350,000 plus owner operators in the network, and divide that by 0.7 to get the number, like the potential capacity unlock there just by using that resource effectively.
Yeah, we actually did some back of the envelope calculations, Bill, and it was 12 minutes. If every driver could get 12 more minutes of driving, the shortfall in the driver shortage would go away. Now we know that's an oversimplification, but 12 minutes, you multiply it by 10, that's 2 hours. I mean, there's a lot of capacity we can unleash here if we use the resources a little more smart.
Absolutely.
Yeah. And a few minutes ago, Chris, you talked a little bit about having the right partnerships, and I kind of want to dig a little bit deeper into that. So when we talk about optimizing our procurement strategies, what should companies look for in selecting the right partners, or what are some of the questions that they should be asking to make sure that they already have the right partners in place or not?
I think you want to use partners that take you to good ball games and give you good tickets. I'm only kidding, right? No, it's funny because partnership, there are different levels of partnership, right? And so I think you'll have a deep, the core carrier concept is alive and well. For certain parts of your network, you want to have the high asset-based carriers there, and and have a very deep relationship with them, because then they can help you in different ways. As you move down to a more transactional basis for certain lanes, than what Bill said earlier, you don't have to have as deep of a relationship. You don't have to marry them, right? But I think you want to have faith in the system that you're using, right? And so I think that makes sense for what we talk about for Uber Freight. But something that we did up here at MIT, and it's a project that we're still working on, but we've had some initial interesting results. We tried to look at the level of trust between shippers and carriers in a partnership or in a relationship. And so the question we're trying to understand is there reciprocity between shippers and carriers, between the peaks and the valleys of the market on that Pickett curve or that coyote curve? And so the question we're asking is, are shippers and carriers elephants in that they have long memories and they'll remember if someone started not honoring the contract, I won't give them more business? Or are they goldfish who have the memory of about 20 seconds, and that no matter what happens in a tight market, they'll forget it in the next soft market? And what we found is that most shippers and carriers are goldfish, and that there is no long-term effect if a carrier defaults and doesn't honor all of its contract, or if a shipper defaults and starts going to a different part of the market instead of what they committed to. So it was a little depressing that we found that we're an industry of goldfish, but it was kind of insightful in that we found that both players, shippers and carriers, tend to be more myopic. And so I think that applies across the board, but as you get into deeper partnerships, you see the reciprocity being a little more stable. Hopefully that made a little sense, but have you seen anything different, Bill?
No, I love the goldfish analogy.
Before we were going to call it chimpanzees because they have a really short memory as well, but goldfish sounds better than saying that someone's a chimp.
Yeah, I would say, having been in many of these negotiations and gone through multiple RFP cycles, every year there always seems to be one or two shippers who are ready to make the commitment, and they're working on a framework that's going to hold them accountable as long as the carrier is accountable, and somehow it never seems to quite come to pass. So I think there's just the way that contracts have been structured historically, there's really no teeth on either side, or carrots and sticks. And so
yeah.
I think it's just the nature of the unreliability and volatility of the network, is that if I'm a carrier and rates go up 40% and I'm still giving my trucks on the contract rate, then right, I'm leaving money on the table. And there's a huge draw just structurally to want to put my capacity out in the market. And if I'm on vice versa, if I'm a shipper and the rates dropped 30, 40%, right? It's like if I want to keep my job and the CFO's knocking on my door, sharing articles from FreightWaves as to how the market dropped, right? It's hard to make the argument that no, it's I got a relationship with these carriers, I'm going to keep it. And that's just been the challenge of the market, I think, historically.
Right.
There are exceptions, but it's it's the nature of everybody's running a business on both ends.
Yeah, you almost have a fiduciary duty to do this. I mean, you're leaving money on the table. It's not fair to your stakeholders, your stockholders, or anything else. Yeah, it's a hard thing to control unless you can somehow justify it that the short-term pain is justified because we'll get a long-term benefit. But that's a hard thing to prove.
Yeah, and talking about trust and even appreciation, because the relationship component around all of this is going to stay important. And we've talked a little bit about that. But as shippers look to not just say they appreciate their carriers, but actually demonstrate that appreciation, have you guys seen any types of programs or initiatives that have been effective in helping to show that appreciation?
Appreciation so on both sides, we see both, there are carrier awards and shipper awards. And I think typically where I've seen the trust in the relationships the strongest is when both parties are as transparent as possible. And I think that's where I see the most successful procurement departments and the ones that seem to do the best job of reacting to market and managing the cost well. It's because they are, I'd say, continually getting signals, but they've also built an amount of trust with their partners or their carriers because they are open as to how they're going to manage the process, what the expectations are, what they see coming, right? And so I do think it gets back, we started the conversation about relationships, but trust, it does come back to trust and trust, visibility and transparency and openness in terms of what's happening. And I think that's really where I've seen the most success in the longest term relationships. Because as long as everybody's being honest on both sides as to what the motivations and incentives and what they're seeing in the market and why they're reacting in a given way, or what they expect from a capacity situation or rate situation, that creates trust. Right? So it's ultimately it's getting the fundamentals right. The more opaque and the more opaque that the transaction is, and the more guarded a shipper is in terms of how they're managing a transaction. Having been in this for quite a while too, you see a lot of interesting procurement strategies played out on both sides. I've seen, target rates as an example. You go through an RFP with multiple rounds, and the first round it's $1,000. You get a target rate back, it's $500, and like, whoa, and the market's $800, and then you find out that they hit an Excel formula where they just took the rates and multiplied them by 0.7. You see a lot of this, which that erodes trust, right? Because then it's like, are we having an open conversation around what's really going on in the market, or are you just trying to get that extra?
I'm shocked and amazed that someone would do that, Bill.
Yeah.
I know the target rates are usually, get what I have and put 0.75 on there and see what the carriers do. Or yes. I only have 2 lanes on this, 2 loads per year on this lane, but I'm going to say 10, so the carrier quote takes it seriously, And then when the other side of this that shippers don't see is the ghost volume, right? That doesn't materialize. So the carriers are bidding on hundreds of lanes, and a lot of times that volume never materializes. And so now they built their network on this, and so it's kind of like ghost volume, and that's a big challenge for the carriers. And I don't think shippers always appreciate that.
Yeah, and I think that's something that shippers should expect going forward too, is that carriers are getting more sophisticated as well, right? So certainly, we look at that data very intently, and I know that others do as well. And a sophisticated carrier will come back and say, this is exactly what you committed, here's what we see, here's what played out, right? And bring a lot more information to the table as well. And again, as long as the partnership is open, everybody benefits, because now everybody's making better decisions. You have more reliable network. You understand what's happening with the rates in the market. So.
Yeah, and so you can use different parts of your network you can treat very differently. So like I was talking about for like high volume, the high critical lanes, you can have a guaranteed volume on there. And now you're not going to guarantee the average. You might have a slightly lower number where you'll pay if they don't show up, and you'll get generally a better rate for that because you're guaranteeing the volume. But you're not going to do that for every lane, obviously. But what this data is allowing you to do is to be more creative in different ways that you can have contracts. We did a project up here with a company where we looked at index-based contracts. So if I have a rate with someone, it will go up or down depending on some index, whether it's Chainalytics, DAT, CAS, whatever index you pick. We found that it could work in different areas because what it's really doing is to lower down the carrier's default rate to try to improve the acceptance ratio. Because when a carrier rejects a load, it's not just paying a higher cost per mile to the next carrier. There's a lot of other stuff. It takes a lot of effort and energy, and it's usually on the lanes you don't want to work on. So there's a lot of additional cost to this. And we found that it worked well in certain situations, but when we dug in a little deeper, this goes to a point that Bill made, shippers were all for it as long as the rates went in a certain direction, and carriers were all for it as long as it only worked in one direction. So they didn't want to lower the rates when the market dropped. So there's this, people don't want to, the give and take is hard to do. They're willing to take, it's harder to give. But I am seeing shippers being more open to experimenting and trying different forms of relationships and being a little more exploratory here. I think the crisis gave them liberty and license to explore some.
Great. And as we kind of look to move into 2020, many companies are well in the throes of shaping those procurement strategies for the coming year. What kind of parting, I guess, priorities or pieces of advice would you guys offer to people as they look to shape up for 2020?
Yeah,
Bill, you want to take that? Yeah.
Yep. I think touching on some of what we discussed earlier, I think first is just having an opinion around where the market's going to go. I think what we're seeing right now is that most people, most procurement departments expect rates to go up in 2020. And we're seeing bids get pulled forward and RFPs that might have happened 2 or 3 months later getting pulled forward to now. We're seeing shippers try to lock rates in. I think the risk of that, of course, is that if the market does turn, that there may be a lot of route and guide fallout if the market really accelerates. The benefit is, of course, is that if there is a more minor rate adjustment, then now you've locked in pretty competitive good rates, right? So if the market goes up, say 2 to 7% or smaller percent, then more likely if you locked in a good rate now, you're probably going to see less route and gut fallout going forward. But if the rates go way up, there'll be a lot more spot activity, more route and gut fallout. So, and I think again, it just gets back to the understanding where the market's going to go. Make sure you have access to good tools. I really think pressing your carriers going into 2020. I think more and more real-time pricing is we're certainly investing heavily in real-time pricing, meaning immediate visibility on what's happening in the market. And we have a 14-day pricing view right now available on our website. It gives much more flexibility in terms of how you manage those exceptions when they do come up. But yeah, if I was going to distill it to one thought, it would be just have an opinion on what's going to happen next year in the market, and then build your RFP strategy around that opinion.
Yeah, that makes sense. And I think one of the things to do is to look at the indicators. So I think everyone's acceptance ratio, if you look back to 2018 versus now, it's a whole different story, right? And so one of the things we do in my role at Chainalytics is we look at rates coming in, and we look at the difference between new rates coming in on a certain lane versus the rates that were retired, the ones that they replaced. And what happened is for the last year and a half, up until about the spring of 2019, the new rates were a good 5% above, depending on the time. It was always above those rates being retired. That flipped in about March of 2019, and the gap is getting more and more. New rates are about 4% below those leaving, mainly on dry van. I'm talking dry van full truckload. And the same thing with spot rates. Spot rates crossed the steady contract rates about 6 months ago, and I don't see it changing anytime soon. We've seen little blips, But to Bill's point, you do need to take a stand, but I think you want to hedge some of your bets. And so I think you don't want to go all one way or the other. I think you want to, again, segment your market, your network, and see where you're at most at risk and lay in those assets that are best appropriate to the variability and the consistency of that freight. One of the things we found by looking at different freight contracts over the years is one of the biggest drivers of a high acceptance ratio by your carriers is the consistency of freight. And I think a lot of this gets to the transparency that Bill was talking about. So if you can let the carriers know what's going to be coming and try to give them consistent freight or those lanes, then you're going to see better results.
Yeah, actually, you make a key point in that if you looked at the tender rejection rate, FreightWaves has the Sonar index that we look at, it was 4 to 5% for a significant part of the year, which was an exceptionally low number, meaning that 95, 96% of all tenders were being accepted. What the risk is that I've seen shippers start to think, okay, my network is so reliable, I don't need as many carriers. I'm going to cut my
Right.
70 to 30, right? And so as you then get back into a much more volatile market, that could be a significant coverage risk, right, as rejection rates pop back up. So I would say, as you're looking at your network next year, just keep that in mind, that rejection rates will likely go back up because they've been at historical lows. Now, one of the things I think that Uber Freight can bring and that a real-time network brings is that we have much more access to capacity. Our acceptance rates are 99% plus. I do think over time networks will become much more reliable as they become more tech-enabled because you have this instant access and instant visibility. But certainly as you look across your portfolio, just be mindful that some of the carriers that might be running 95% this year, they may not be in that same position next year.
Yeah, and I think one of the points you made earlier, Bill, was spot on. Look at your systems, whether it's procurement or tendering, and see how anchored are they to the annual bid cycle. It used to be painful. I mean, when I first did bids, we sent out floppy disks, right? And carriers would have to take them home because they had better computing power at home than they did at their offices. And they'd complete them in spreadsheets and all this. But look at your own systems. Look at the things. How much time does it take me to put in a new rate? Can I change my rates? How quickly can I adjust? We did a quick survey to try to find from shippers how amenable they would be to shorter term contracts. And I was shocked at the few number of shippers who wanted to go to 30, 60, or 90-day contracts, even though that's probably when they have the best visibility of what their real volumes are going to be. I think that's going to shift, but I think some of the hesitance is, one, shippers still are clinging to that idea that I have a contract rate and so I can budget and plan on that. But two, the systems aren't capable of being that flexible. So I think get to know your data, but also look at your systems and see where you need to upgrade them, your processes, your people, and the technology to make it more flexible so you can adjust and change when the market does turn, because it will turn. You're not caught flat-footed again.
Mm-hmm.
Yeah, great perspectives there. Thank you guys so much for sharing those. We'd love to leave some time here at the end to take questions from those of you in the audience. I see several have already come through, so feel free to keep submitting those. We'll take as many as we have time for, and we can always follow up with you after. So don't let time be a holdup for you. First question, what is the best way you found to bring quality carriers that aren't technologically savvy onto the path with electronically sourcing events? Bill, do you have any thoughts on that?
Sure, because as an intermediary, we work with all different types of carriers. I would say it's hard to answer this precisely without understanding the technology environment that you're operating within. I would say there are great third-party bidding tools that can allow carriers to be more thoughtful and provide good feedback. I would say from a carrier perspective, my advice to carriers would be to get informed, get access to data. There's good third-party indices on rates that are available. Chainalytics, of course, publishes rate data. I think that for a shipper, the more information you can share, again, with the carrier, and the more insights you can share with the carrier. And I'd say also having an open conversation with the carrier around what are they expecting? What data do they have? How are they thinking about the market? So I think challenging your carrier to make sure that they're doing the research too in terms of how they're thinking about the data that's available out there. I think where some of the smaller carriers will have a challenge is how do they stay abreast with like real-time pricing APIs and some of the new tools that are coming down the pipeline that, as Uber Freight that we're driving and others are driving. So that's, I'd say that at first as a shipper, typically one thing to note about the marketplace is shippers usually have more resources, more capital, better technology. The market is, you have bigger shippers and smaller carriers. That's just the nature of freight in general. So as a shipper, the more information you can share, I think you're going to better arm your carriers to make good decisions and to give you rates that they can commit to. So.
Yeah.
Great. Yeah, that makes sense. I have nothing really to add.
Okay. There was some interest, Chris, in the trust research that you mentioned, and people are just curious if that's available. Can you speak to that?
I have a PhD candidate rapidly writing it up. So as soon as it's available, I'll let you guys know. Maybe we'll have another podcast or another webinar on it.
Is that going to be a thesis? Or is it D-space? Or
it's going to be part of but it's going to be a while for that. It's a doctoral dissertation. Angie Acocella is working on that. It'll be part of her dissertation she's working on.
Awesome. Thank you. And a couple of questions as well about air and ocean freight. It says, I understand the procurement approach for FTL and LTL, but what about other international modes such as international air freight and ocean freight? When we look at the differences in the uniqueness of the products and additional accessorial fees or regulations, is there one mode that's ideal over others? Bill?
Yeah, sure. I'll start. Maybe Chris can add, because I'll admit I'm not an air and ocean expert. I think there are very fundamental differences in terms of how the markets are managed. In that air and ocean, you have a smaller set of providers. Rates are typically provided up front, be it tariff or pre-negotiated. Is where in truckload you have a significant percent of the market, particularly on the buy side, meaning that with carriers, that is negotiated load by load. And so as a result, procurement is very different in terms of how you contract up front and then how you actually execute. I think within air, as an example, right, it's a smaller set of providers. You typically get a rate card. It's going to be negotiated well in advance, and there's more of a commitment, and it's much higher capital cost to operate those networks as well. So they just are structurally much different. But I'm not an expert. I'm curious what Chris's opinion is.
Yeah, I am also not an expert. The thing is that the North American full truckload market is unique. And that's the thing. And it's so big, $300 billion, that's why we have all this focus on it. The whole industries are on this. Other transportation modes tend to have much fewer carriers. So for the ocean, through the acquisitions, the big three and all that, you're negotiating with much smaller numbers. So when you talk about full truckload, you have a perfectly competitive market. And what that means is the price is going to be dropped down to, it's going to be a cost plus kind of business. So therefore you can model it better. It's easier to manage that way. When you're dealing, same thing with parcel. If there are only 3 vendors you're dealing with, you're not going to have an auction, right? You're going to have a negotiated discussion, and it's going to be very point by point. And you see that across most of the other international modes. Ocean by itself is weird, right? Because you're driven by other factors. Rates will just be changed unilaterally. There's a lot of market pressure there that has nothing to do with the underlying transportation network. It's more global forces. So all the tools and things that we're doing for domestic transportation, a lot of it doesn't apply to those international modes. I was just in China though, and their trucking market is shockingly similar to the US. And they have thousands of really small carriers, and they're facing the exact same problems that we are. But international transportation, I think, is its own very different, distinct animal.
Yeah, great. And next question, do you see the RFP process greatly diminishing from transportation procurement in the future? And what alternate procurement models would you envision that would pick up going forward?
I think there will always be an element of a long-term relationship like that, and whether they're evergreen contracts, right, where you set something up but you revisit them once a quarter, let's say, and adjust those. I think you're going to see some of those, but I think you're going to see more and more freight moving to more, not purely transactional, and Bill and I might not agree on this, but I think you'll see more use of shorter term, more flexible, more dynamic contracts. And they might be just for 90 days, they might be for 120 days, it might be something in the middle. As long as the systems can handle those, and it doesn't take an hour or 2 hours to implement that, I think we're going to see more of those.
Yeah, I would agree with that. I think that, we talk a lot about real-time freight, but to me, it's not just about, today in this moment, moving freight right now. It's also about getting information in real time. And I think a real time, like a short-term contract is an example where you could get a contract price through an API for a fixed term and do that in real time. I think that starts to change the RFP process as well. We're already seeing that demand from some of our shippers. And I think there's an interest for shippers in how to make the RFP process more streamlined, easier,
right,
more tech-driven. So I think there will always, to Chris's, be a place for medium to long-term contracts and commitments. Certainly, you need that. You've got to be able to hedge against how you're managing your own supply chain and the decisions you're making internally, what those planning horizons look like. But I do think more and more of that can be driven in an automated way without having to go through a very manual process of emails and phone calls and face-to-face negotiation.
Right. Yeah. I think, data is going to make that, and the processes are going to make that much more streamlined. And as the friction goes out, then we'll be able to do it more frequently, just like with anything, right? As you make it easier to do and the transactional costs go down, then it's going to be easier to do those transactions. But the big other block is that shippers, they have this, the budget planning. I need to know exactly what my budget's going to be, and when in fact they know it's going to change. So I think there's a lot of mindset that still needs to change, even if the technology catches up.
Yeah, absolutely. And next question, have you worked with companies that use machine learning to run the RFIs and RFPs?
It depends how you define machine learning, because that could mean pretty much anything, right? Regression. Usually the RFPs use optimization, which is not quite machine learning. Machine learning is more of a statistical approach of some sort, where you're looking for patterns or categories. So I've seen machine learning used to identify opportunities, things like that, or forecast or try to understand how rates will change. But usually the selection of lanes to carriers is done in some kind of optimization, usually a mixed interlinear program that's embedded in whatever software that you're using. But Bill, have you seen, you guys use a lot of machine learning for different aspects?
Yeah, we use a lot of ML. We bring a lot of tools to bear on the rate, on how we determine rates on both sides of the market. I have not seen it specifically on the shipper side. I would expect, though, that as the data becomes more real-time and available via API, that I would expect that there's going to be some clever innovations in terms of how shippers think about that, how they manage rates, but I have not seen that yet.
Yeah, I think you're going to see it in the real time, making that decision, okay, should I take this alternate action? Should I lock something in for the next 2 weeks because I think I see something happening? I think you're seeing inklings of that now, but it's almost manual at this point. But I think you're going to see them being incorporated into the processes and into the systems eventually.
Yeah, I think that's very much a developing area. And if I were a betting man, I would bet that in the next 5 years, you'll see some very clever, like a bid management tooling that's all done just via ML and other tools to come up with the optimal decision for any given circumstance based on here's the real-time rates, here's what you see in the market in terms of available capacity, here's our contract rate. Make a smart trade-off between those.
Right, I agree.
Great, and I think we've got time for one more here. What minimum procurement innovations would you suggest a company should have in place to be successful in the current dynamic market?
Well, Bill, I guess you'd say that you should have an Uber Freight account, right?
Yes, yeah. Sign up for Uber Freight. I think that's definitely.
To be honest, a lot of what's happened for shippers is there's a lot of things that's just machine to machine. I mean, to be honest, straight EDI is machine to machine. Now it's pretty slow and has latency issues and everything, but APIs, I think the system works better than people give it credit. And so I think having a TMS is critical. If you're a buyer of transportation of anything north of $1 million, I think you need to have a TMS of some sort. And that will enable you to not only adhere to a routing guide and talk to carriers, but also to analyze and maybe start improving the processes themselves. So to me, the minimum level is having a TMS, a transportation management system.
Yeah, and I would build on that because we have partnerships with Mercury Gate and SAP, and we are working, and we will be working with many of the other providers. I would say though that that market is also rapidly evolving, and the capabilities that will be native in the TMSs will evolve rapidly. So I'd say be mindful of that. If you don't have a TMS, you need a TMS, but then also that what a TMS does will be evolving very rapidly as well.
Fair enough. Fair enough.
Great. Well, thank you both. And thank you to everyone who's listening in today. That is all of the time that we have for today. We appreciate you for being here. We appreciate Uber Freight for partnering with us on today's presentation. And of course, Bill and Chris, thank you again so much for sharing your insights with the audience today. I know it was super compelling, and we have tons of questions that I know you guys will be happy to follow up on. So again, thank you guys for joining us this afternoon. Hope you'll join us for another webinar again soon. Take care.
Great. Thank you.